Hello and welcome to Market Domination. I'm Josh Lipton, live from our NYC headquarters. Investors watching whether Trump's China tariff deadline will be updated. An extension may be in sight, according to U.S. Treasury Secretary Scott Bessent. And we're just learning that a trade deal has been struck with the Philippines. Going to have a lot more on that story coming up. For now, there's still an hour to go until the closing bell, and stocks are looking mixed on the news here. Let's welcome in Daniel Newman. He's CEO of Futurum, our Washington correspondent. We've got Ben Werschkul, and markets and data editor, that would be Jared Blickery. They will all be joining us throughout the show to break down the headlines. Jared, let's start with you.
All right, as you said, we have a mixed market right here. Let's check out the Dow, which is up a whopping 161 points. Nothing to write home about, but we are close to record highs, and this is what you see in a bull market. This is year to date. Let's dial this down to an intraday, and you can see very choppy action around the open here. And then we are just off of the highs right now. NASDAQ, a little bit of a different story. We're going to check in on the sectors in a minute, and tech is leading to the downside. So you can see here right at the open, we saw a little bit of a downdraft, and that's kind of taking care of the NASDAQ right now. And then the S&P 500 up 14 basis points, just crawling into the green a few minutes ago, hasn't spent most of the day there. So I think investors will take that. And then the small caps. Small caps are leading. Russell 2000 up at 0.9%. And we got to check in on the bond market because yesterday we had a pretty big downdraft in rates, and that is very supportive of equities. Let's get the two-day view, and you can see, there we go, down to 4.9%. And just a few days ago, we were above 5%. That was causing some equity spillover, a little bit of a headwind for stocks there. That is in the rear view mirror, and we're also seeing the US dollar down. And so that sometimes supports stocks, but today we're just seeing kind of a ho-hum day in the markets. Now, here's the sector action. Healthcare is in the lead. It's up 1.75%. Following that, we have real estate, the materials, utilities, consumer discretionary, staples, all of those on the top row. As I said before, tech is the lone sector in the red here, and we can see this playing out in the NASDAQ 100. Just check out the mega caps, most of them underwater. NVIDIA down 2%, Broadcom down 3%, Meta down 1%. And I'm going to show you something unusual here. This is going to be the utilities sector. You don't always see a sea of green like this, but it has been like this for about 3 or 4 days, hitting record highs, and there we go. So I'm going to send it back to you. Kind of mixed action today.
Mixed action. Well, there's no doubt investors also eyeing news of the new trade agreement and what will come out of Washington next. We bring in now Ben to catch us up on the ever-changing trade policy talks. Ben, what is the latest?
Yeah, Josh, another day, another series of trade headlines. The two big ones you mentioned right at the top are, the first is a trade deal, apparent trade deal with the Philippines. The Philippines, the president was in Washington today visiting with President Trump in the Oval Office, and he apparently came away with the trade deal there. The main parameters there are all we know so far, but it's a 19% tariff of goods coming in from the Philippines and a 0 tariff on goods going to the Philippines, according to President Trump. This is in line with a lot of the other deals Trump has announced in the region. Vietnam and Indonesia in recent weeks have gotten similar rates and similar overall terms here. So we sort of have progress on that front, and this is all clearly in China's orbit and clearly aimed at that. And that's the second headline, is China here, which we know that there's going to be China talks next week in Stockholm, Sweden. Treasury Secretary Scott Bessent announced that earlier today. The goal here is to extend the deadline with China. China has a slightly different deadline of August 12th when they could see tariffs rise. The word Bessent used today was likely that there'll be an extension there as they talk about a range of things like open markets. So those are the two big ones today as we get closer to this August 1st deadline.
And Ben, also out of Washington today, Trump making new remarks, possibly on the Fed chair's future. What do we know there?
Yeah, we saw an interesting softening today, both from Bessent and Trump, in terms of the question of whether Powell was going to get fired. Trump didn't engage with the question. He was asked by reporters today. And as Bessent in a TV interview, his quote was, "There's nothing that tells me that Powell should step down right now." So that's a kind of stepping away from this question of whether Powell is likely to be imminently fired there. But I'd underline that it doesn't mean that he's going to have smooth sailing. There's still a lot of points of political pressure that Trump is moving forward with towards Bessent over these renovations at the Federal Reserve headquarters. We have the other thing to watch for later this week is we have a site visit coming on Thursday. We learned that today from the National Capital Planning Commission. This is a group that Trump recently restocked with his loyalists that are going to go to the Fed and report what they see there of this renovation. So it's going to be an ongoing story, but at least for now, Powell doesn't appear to be imminently in the hot seat in terms of being fired.
And Dan, I want to bring you in here as well. I want to continue the conversation, Dan, on trade and tariffs, and specifically, Dan, through the lens of the sector you know very well, of course, that would be the tech sector. I know, Dan, you say in that conversation, in your opinion, it all really starts and stops with the chips.
Yeah, the 232 investigation is one of the things that has left a little bit of uncertainty. We've heard about the taco trade, and we've heard that, how China has sort of continued to be extended. We know how important that is. We're seeing some of these different countries across Asia that have impacts to the semiconductor supply chain. Those are starting to come together. Deals are being made. We know the supply chain is very global. We saw back during COVID how much it could be impacted. We know that getting these deals done is so important. And of course, the tech sector, AI as a whole, is really going to drive the next multi-decade wave in global leadership in the economy. And of course, President Trump wants to be sure that the U.S. is leading when this is done.
During this chip earnings season, Dan, AMD, Intel, ARM, Qualcomm, what would be some of the big trends and themes you'd be looking for?
Of course, we're going to see, does this CapEx number sustain? Has there been any lagging effect of tariffs? We haven't seen it in the numbers yet. And there's starting to be some thoughts that maybe the economists that all had guessed that these tariffs would really come in over the next few quarters and start to impact the economy in a big way. It may not be as big of a number as we thought. And of course, is tech really susceptible to all this? The overall AI trade, it's very deflationary. We know companies are getting efficient. We're seeing deals being made around the world for big AI chip numbers. We're also seeing companies like Microsoft cutting staff, and AI is part of the reason. So we're going to be listening to those narratives throughout big tech earnings over the next couple of weeks. All
right, for a closer look now at the market action, let's get to Argent Capital Management Portfolio Manager. That would be Jed Ellerbrook. Jed, it is good to see you. So with stocks near record highs here, Jed, what is ahead? Are you feeling confident? Are you cautious? What are you telling clients, Jed?
Yeah, I think an optimistic outlook for the second half of the year. I think corporate earnings growth is pretty strong. Consumer spending is hanging in there. So long as we can keep the tariff headlines from dominating the news flow too much, I think this economy will power ahead, and AI is going to lead the stock market.
So your point of reasons for bullishness there, and listen, we have folks who are constructive on the market, Jen, and they'll say, listen, they look at the fundamentals, they see broadly solid earnings, solid economic data, they see a Fed that appears like it wants to cut in the back half. What would be on your wall of concerns, though, Jed? Because sometimes I get nervous when nobody seems nervous.
A few tariff, headwinds appearing this quarter. I think the auto manufacturers have reported that, both Stellantis and GM, major tariff impacts. I think we'll continue to see that in the real economy, trucking companies, et cetera, impacted by the tariff threats. That August 1st deadline looms. I think it'll probably continue to get pushed, as we've seen so many times in the past. But eventually the rubber will meet the road, and 90 trade deals is a lot. I think that's number 6, the one mentioned today. So a lot to go there. There's some risk there.
How would you broadly, Jed, characterize the earnings season so far? I know it's still relatively, early days. We did hear from the big banks. Big tech is on deck. But what have you learned so far?
It seems like most management teams set a conservative bar for the second quarter when they gave guidance in April during the height of the Liberation Day tariff fears. So we've seen better than expected earnings results so far this quarter. You're right, just the big banks for the most part. Some aerospace companies have reported. There's still a lot to go. Big tech will follow here over the next 2 weeks. But so far, better than expected. The economy's hanging in there.
Another theme front and center, of course, will be AI. And you say something here. You say investors have been underestimating AI investment and use. What do you mean by that?
Data center CapEx spending continues to rise each quarter, and expectations for the future continue to rise. NVIDIA's sales each quarter beat and they raise. So we're seeing AI infrastructure investment continue to be revised higher each quarter. And then we're also seeing really strong adoption of AI tools, I think, in the broader economy, financial services companies, healthcare, businesses. And then, of course, tech is applying their own AI tools to make their businesses more efficient. We're seeing margin improvements all over the place within the tech industry. And I think AI has a lot to do with that.
What do you make of that, Dan? The idea that investors they're underestimating AI investment use.
Well, we just heard Sam Altman come out and say he wants to, take his GPU count from 1 million to 100 million. That's $3 trillion alone there. You've got this FOMO going on between Mark Zuckerberg, Sundar Pichai. They're all racing and chasing super intelligence. They're making $100 million employment bets to try to bring talent in. This isn't for nothing. This is a $20+ trillion economic opportunity, and we have the AI chip business alone by the end of the decade at over $1 trillion. So we actually think that's conservative based on the GPU counts. And you heard Elon Musk got into this conversation today too, pushing what he's doing with Colossus. Everyone is racing to get there. The one risk I still think is consumption isn't as good, especially in the enterprise. We are seeing a slower POC to enterprise-wide deployment of AI. There's a lot of interest, but the reason that's not going faster is so much technology debt sits inside these enterprises, and moving from CPU era to the AI GPU era has been harder than most had thought.
Jed, I want to end here with some picks, some names. Among your favorites, you say, is Amazon. Heading into this earnings print, Jed, why is that a favorite?
Yeah, I think that they have strong revenue growth prospects in both businesses. Retail, I think, is performing well. Their biggest competitive advantage there is the huge warehouse network and all the efficiency improvements they're making, deploying robots all throughout the warehouse space. Over 1 million deployed now. That's going to continue to grow rapidly, and margins are going to push higher as a result of that. And then on the cloud computing business, we're seeing a high teens growth rate. I think that'll accelerate here over the next year and continued really high margins. So I think Amazon has a lot going for it right now, and I think valuation is reasonable. The stock has not been a great performer year to date, mostly due to tariff concerns, but I think that concern is more in the past at this point.
And Jed, a final one here. I just want to get your thoughts on. Of course, we're all familiar with Amazon. Here's one I'm less familiar with, Jed. You like it. TransDigm, ticker TDG. Why is that an opportunity?
Yeah. Air travel continues to grow. The economy's hanging in there. Leisure travel is a little bit weaker, but corporate travel and overseas travel remain really strong, as does the first class cabin. So that means aftermarket revenue growth for the aerospace suppliers is strong. High single digits, low double digits. GE just reported their engine aftermarket business grew, I think, 25% year over year last week. And so, yeah, that's the aerospace aftermarket side of the business, strong double-digit growth. And then the OE side of the business, sales to Boeing and Airbus are ramping up as well because Boeing is finally getting its act together and ramping up production. So growth there as well. And then the third piece of the stool, the defense exposure for TransDigm, the U.S. defense budget continues to grow at a double-digit pace. Trump is trying to expand that Defense Department budget as much as possible. I think he's targeting a 13 or 14% year-over-year increase. That's going to roll down and help all of the defense equipment suppliers, TransDigm included. So I think all three parts of their business are firing. And also they've got plenty of capital to invest in either acquisitions or a one-time special dividend to shareholders, which they typically do around year end. So I think shareholders are poised to win either way.
Jed, appreciate your time and those stock picks, sir. Thank you so much for joining us. We are just getting started here on Market Domination. Coming right up, Big Pharma is in focus. We're talking to the CEO of AstraZeneca on what Washington policy means for manufacturing. We're also learning new information about the wildly successful GLP-1 drugs and what it could mean for your portfolio. Alphabet stands ready to report earnings, and Wall Street seems to still be sweet on the tech giant despite some data. We're taking a deep dive into Google, and we're giving you the best plays in defense stocks. Stay with us. We're talking to an expert in the sector. You won't want to miss it. All of that and more coming up. Now time for some of today's trending tickers. We're watching Oracle, Amazon, and NXP Semiconductors. Let's start here with Oracle, which is seeing shares fall despite announcing a partnership with OpenAI to increase Stargate's data center capacity. The 4.5 gigawatt investment in the OpenAI and Japanese SoftBank-owned company is expected to accelerate U.S. industrialization, create new jobs, and expand the United States' position in all things AI. So your thoughts on this, Dan? Oracle and OpenAI, they announced, okay, we're going to develop 4.5 gigawatts of additional U.S. data center capacity to expand this partnership. It doesn't sound like we have firm locations yet for the data center sites, but Sam Altman's company is saying, in fact, it'll have more than 5 gigawatts total capacity, more than 2 million chips for AI work.
What a story Oracle has been. You know, it's one of those companies that a lot of people had written off. They were old, they were antiquated, they're CPU era, first generation applications.
right.
They're moving into AI, they have the fastest.
And Larry Ellison says, watch this.
Fastest growing cloud business. They're deploying massive gigawatt data centers all over the world. Stargate's a little slow, but I like Oracle a lot.
Do you agree with this? I saw a note from the smart folks over at Evercore. They said this about this news, and about Evercore. They say, we believe the growth potential associated with OCI remains the primary driver for the shares in the near term, and we expect, they said, street estimates likely to push higher coming away from the company's next earnings call in September.
The most important data in every enterprise either sits in an Oracle or an SAP instance. Bringing AI and compute closer, it's been the absolute champion of Oracle's run. And look at the returns that investors that stuck with the company are seeing now.
Yeah, we need Larry and Saffron on Yahoo Finance. That's what we need.
Make it happen.
Open invitation. Also, Needham, let's look at this one, lifting its price target on Amazon from 220 to 265, reaffirming its buy rating for the e-commerce platform. So this one actually, so Amazon, obviously earnings are on deck. Ahead of that, Dan, analysts are busy raising their price targets, right? Citi goes to 265. They say results should beat expectations for revenue and operating income. Needham, we mentioned, goes to 265. Talk about strong AWS revenue growth and margin expansion. Record-breaking Prime days they call out in Q3 should drive upside to the outlook. HSBC goes to 256. They talk about fundamentally well-positioned, they say. It's already delivered a solid start to 225. We know the stock this year hasn't done a whole lot. Your thoughts?
Well, there's some unsung heroes in the business. Their advertising business is growing over $40 billion. Doesn't get a lot of credit, very high margins. AWS growth has lagged, but you have to remember, $120 billion plus business, and their AI play is starting to catch up. They got out the gate a little slow on the agentic and generative AI, but they're building models, they're deploying infrastructure, and they have that massive installed customer base. So there are reasons to like them, and AI and robotics, physical AI, is a real tailwind for that company in the future. They can bring the cost down and make that e-commerce business more profitable.
All right, third one I want your take on, Dan. NXP reporting a beat on earnings estimates for the second quarter. Chipmaker also seeing acceleration in its automotive business from the second into the third quarter. So this one, I did see the third quarter forecast that was lower than maybe some had been forecasting. We know this is a name, depends a lot on the auto industry. You can see we're down about 0.4% there. The auto industry accounts for a lot of this company's revenue, an industry trying to navigate, obviously, the Trump tariffs. The CEO did say here, automotive business accelerating massively from the second into the third quarter. Sounds like what they're saying is once we get through this glut, his point is we should benefit, we're well positioned. You say what, Dan, on NXP?
Every company that wasn't in the AI GPU trade kind of got written off over the last handful of quarters. That inventory buildup, whether it was FPGAs, whether it was CPUs.
Sort of auto, industrial.
Remember, those were the essential chips that crushed supply chains, and everyone was chasing them. And then AI came, and then everyone forgot about them. And really the only reason the stocks moved up was the NVIDIAs, the AMDs, the ARMs. Those companies are due for a rotation back, and automotive is actually a big AI play. All this ADAS, all this autonomy is going to also need those essential lagging edge chips. Companies like NXP should see some revitalization now that that inventory is sold out.
All right, we'll keep watching. Meanwhile, pharmaceutical stocks in focus as we approach President Trump's looming drug tariff deadline. For more, we want to bring in here Yahoo Finance senior health reporter Anjali Kamanj.
That's right, Josh. With that looming deadline, potentially August 1st, for up to 200% in tariffs, we don't know what that number will actually end up being. We've heard from several companies that have announced manufacturing commitments in hopes to thwart that effort. That includes AstraZeneca. We spoke to CEO Pascal Soriot about that, and he did mention that the announcement for $50 billion, that's in addition to a $3.5 billion last year, is in part a response to Trump's tariffs. We know others like Eli Lilly and Johnson & Johnson have also announced similarly big announcements of commitments for manufacturing. And this is in play at a time where the industry is also going through a bit of tumult. We know that there is a lot of investment in one of Trump's least favorite countries, that is China. That is the reason why there has been a lot of tension in the biotech world. We also know that Big Pharma has been pivoting and investing there as well. Licensing deals and the like are on the rise as they look to sort of respond to all the different countries that are looking for what has now been termed health sovereignty. And this plays into that. So when I asked Pascal about that, about China and the deal making there, here's what he had to say about it.
We believe that it's our ethical responsibility to bring medicines to as many people as possible. Of course, there are limitations to what we can do, but we work very hard to do this. And we are lucky enough, or good enough, or both, that we are growing, and growth brings opportunities. And because we are growing, we are able to invest in the United States for the United States. We're able to invest in China for China. And we're also able to seek innovation where it happens. Because actually, if innovation happens in China or in Europe, we need to take this innovation, develop it, and bring it to patients, for instance, in the United States, but manufacture the product in the United States. And I think that brings me to an important point that people don't talk enough about, is that today, innovation in our industry takes place in the US. US is the biggest innovator for biopharmaceuticals. And it's really important that everything is done to protect that innovation. It's a fantastic engine to bring new medicines to patients, but also create good jobs, well-paid jobs, and economic growth.
So as you can hear, a lot of focus on that, on economic growth being the driver as well, and needing to respond to these countries and their efforts. AstraZeneca also talked about how it would help shift revenues for the portfolio with a greater reliance on the U.S. Currently, 42% of revenues comes from the U.S., and with this increase in manufacturing, it would be 50%. And that includes GLP-1s. We know that there's a lot of global demand for that drug and for those types of drugs. AstraZeneca has been pursuing an oral form or pill form, which is largely seen as the next frontier in this space. AstraZeneca looking at being able to then supply the rest of the world from the U.S., making it a larger exporter. So here's what Pascal said about that.
It's also another reason why we're investing in this very large facility. We have our oral GLP-1. Everybody knows GLP-1 by now. These are agents used to help people manage their weight. We have an oral agent, and we have bet on oral agents because we think they are going to be easier for patients because they will be cheaper, they'll be more accessible, and we'll be able to export them around the world, not only supply America. But we also have other products treating cardiovascular metabolic disease. We have a new agent for hypertension for patients who are not controlled on multi-medicines. We have an oral PCSK9 for the control of cholesterol and many others. Cardiovascular metabolic diseases are the biggest killer in the world today, including in the United States. So you can see the needs are enormous. This plant will supply products for American patients. So American patients will access products that are American-made. But this plant will also export to the billions of patients around the world who need these medicines.
The company really moving that pot of money, globally and looking at where it makes the most sense. Pascal also did tell me that in looking at the different areas of the world where the money can be, invested, China, of course, being one of them. And then if you compare the amount that has been put in there, that is $5.3 billion is one of the latest deals that AstraZeneca has done in China. And if you compare that to the $50 billion, while not on the same level, you can still see it's quite a large number. And that's just one of those deals. So we're starting to see a little bit of bifurcation in how the global pharmaceutical economy is functioning.
Anj, here's a question. Bottom line, do you believe that we're really going to see President Trump ultimately impose a 200% tariff here?
I do believe that the industry thinks the 200% is more a threat than reality. In reality, there could be some components of drug making that see higher tariffs than others. It just depends on what that 232 investigation reveals and how the administration plans to manage this intense lobbying on the manufacturing front from the pharmaceutical industry, plus the components that are going to be made and the components that already exist really overseas, large scale in Europe and Asia. That's really an over-reliance there on many of those components. So it just depends on how that pans out.
Do we have any line of sight on as to how hard the industry is lobbying right now to get the Trump administration, to get the White House to reverse course on some of this?
Yeah, it's intense. I mean, there are company executives who have told me that they have met with President Trump on this topic. We've seen, instances of those companies visiting D.C., being in D.C., definitely having those conversations. They are not letting up. They are really hoping, and they've said in as many words, including AstraZeneca CEO, that they're hoping to address the tariff threat through this reshoring of manufacturing and growth and expansion of manufacturing in the U.S. to kind of reverse that effort. And if they do still get hit with it, that's going to make medicines more expensive broadly, which would really counter the Trump administration's efforts to lower drug costs. So it is really a complex puzzle, and that's why it's never really been addressed before. But the lobbying is certainly hard and ongoing.
All right, Anj, thank you. Appreciate it. Stay with us. Alphabet earnings on deck. We're going to get you prepared for everything you need to know. That's coming right up. Alphabet set to report second quarter results on Wednesday. Analysts overall optimistic on the tech giant. The stock having 63 buys on the street, according to coverage tracked by Bloomberg. But while there are attractive trends at play for Alphabet, we know the antitrust risks for the Mag 7 stock do hang its overhead. Here to discuss this and more, got Needham senior media and internet analyst Laura Martin. Laura, it is great to see you on the show as always. The concern for investors, Laura, on this one, as you well know, when I'm looking at the stock, it's basically flat year to date, is how AI is going to disrupt search, how it's going to disrupt Google's bread and butter. I'm sure you get questions, of course, from your clients about this, Laura. What do you tell them?
So I think what we need to see, we're looking for Google to report 9% search growth, 13% YouTube growth, cloud growth of 10. What we want to see is that search number, that search ad number, sort of holding up right around double digits. The above 10% would beat the whisper number. Below 9% would be bad. That would imply that generative AI answers is eating into their revenue per query. They're telling us that the revenue is equal, so that's why growth hasn't slowed. But if we see a break in that, that would be bad for the shares. But so long as they report over 9% ad revenue growth from search specifically, I think the stock's fine. It bottomed in April. It's had a nice run since April. But as you say, year to date, flat from the beginning of the year to now. So we would expect better performance in the shares if search breaks double-digit growth, revenue growth in the second quarter.
As Google now finds itself in this competition with the likes of an OpenAI, what would you say its competitive advantages are?
Well, I think the most important thing that people miss about Google is that, it has a dominance in search, which is now threatened, I guess. But okay, so search. But it also happened to have the number 2 mobile choice, which was Android. It now has a cloud business, which Amazon invented, and these guys were late to, but they're one of 3 winners. They're one of 3 cloud companies with Amazon and Microsoft. And now it's got the Gemini, which is one of the top 2 or 3, depending on who you ask, large language models, proprietary large language models. So in every case for the last 4 technological disruptions, Google has a place to play. And these are winner-take-all economics. So what's nice about Alphabet is that in each one of these tech waves, they've had the human capital to take advantage of it and the strategic position. And as we all know, with generative AI, data becomes more valuable. And who has better data than Google? Between YouTube and search, they have data that's second to none with their 3 billion active monthly users. So I actually just think they're really well positioned strategically for the generative AI future.
You mentioned YouTube there, Laura. We talk about Netflix a lot on the show, and for very good reason. I'll tell you that in my house, though, Laura, for my 6-year-old, YouTube all the time. Dedicated YouTube fan. You call YouTube here the most valuable company in TV today. Talk us through that.
Right. So we value YouTube every single quarter, and we think it's worth 1/3 of the overall Google empire. We would love to have regulators spin it off or have Google spin off even a part of it, because there are many people who own Netflix today or Disney or Paramount who would like to own YouTube, because YouTube is 12% of all streaming and Netflix is 7%. And Netflix is the second biggest competitor. So people would love an option to not own Netflix and to own something larger, which is YouTube, but they aren't willing to buy the search risk because they're media investors. They aren't willing to buy the search risk that search gets replaced by generative AI. So we really think there's a lot of upside if YouTube was separately tradable from the Google parent, which is threatened by AI. YouTube only benefits from generative AI.
All right, so that's YouTube. I also want your take on robo-taxis, Laura, because Google's Waymo, of course, way ahead of Tesla right now. How do you think about that business?
So Waymo gets caught up in something called other bets, and they just lose a fortune. They make no money. They make no revenue, and they lose a fortune. So from my point of view, these companies, and this includes Meta and Amazon, they should cut all this stuff out, my opinion, and put it towards generative AI, where I see the clear benefits in cost cutting and new product introductions. So if it was me, I would walk away from Waymo. However, that is not a consensus point of view. I think, to your point, they are way ahead in this sort of driverless car taxis in certain markets. So, I wish they'd sell it then and monetize it, because I think the future of this company is data-driven, and that has to do with generative AI. And not, automated taxis. That's my point of view.
We talked about some concerns that some have here, and talked about search, Laura. Another one would be, the antitrust front. The Justice Department asking, to force Google to divest its Chrome browser business. How do you think that shakes out, Laura? What's the ultimate punishment here? What could be some real remedies investors should be looking for?
Right, of course, the irony isn't lost on you that they're getting punished for being a monopoly in search at the time when their monopoly is going away, because Perplexity and OpenAI are taking share from them every single day. So the regulators are looking at data that's 2 and 3 years old, which in the tech world, if you're 6 months out of date, you're irrelevant. So the search is under siege from new competitors here. I think the regulators are threatening to spin off Chrome. We just have to see, because the whole court process is so elongated. And an investment time frame of 1 or 2 years, which is actually shortening, I just don't think our timeframes are equal with the courts, with all of the appeals required. So I just think we have to ignore until it shows up in an investment timeframe, which is over the next year. But every single day that goes by, every single month that goes by, Google is losing its search dominance to other competitors because of generative AI.
Having said that, Laura, I know, listen, you tell your clients this one's a buy. As we head into this earnings report, and clients ask you, okay, that's the base case for your buy, but what are the downside risks we should think about? What do you tell them, Laura?
Right. So what to look out for that we fear? They ran out of capacity for their cloud business. I think that's incompetence, in my opinion. So we want to see them be able to drive growth in the cloud. We want to see them have margin upside, because whatever they're allocating money to, Waymo would be a great example, they should stop and build servers so they can be at the forefront of these generative AI innovations, would be my opinion. We need to see where they're doing on cloud growth. We need to make sure that their search ad growth does not fall below 9%, which means it's not being threatened by the generative AI replacement. And we need to see YouTube continue to be healthy, sort of up double digits. So, I think we have to look for negatives here. Look, the stock's cheap at 17 times next year's earnings, which I think is round numbers, half of the S&P average. With all of these enormous, the human capital advantage here is enormous. We see Meta paying $100 million per person over a 3-year period to attract people, and they aren't getting anybody from Google. They got one guy from Alphabet. All the rest are coming from OpenAI and are moving for the money. People underestimate the human capital and how they like working together under the Google umbrella. And that's really valuable, in my opinion, over the next 10 years.
Laura, always good to see and to have you on the show. Thank you. Dan, I want to bring you here as well. Alphabet earnings on deck. Your expectations, Dan.
Well, look, I think there's a lot more upside. First of all, we heard in that interview, there wasn't a lot of credit necessarily given to the infrastructure work that Google has done. Over a decade, Google Brain, DeepMind, building the TPU. They're the only company that really is building and training and deploying next generation, highly rated models. Gemini Advanced, one of the best out there on their own infrastructure. So their dependence on NVIDIA gives them an advantage over the next few years. Not to say NVIDIA is not great, but the fact is vertical integration, margin enhancement, being more in control of their destiny, not fighting necessarily to get their hands on as many GPUs as some of the other companies are. So I really like that. And I also think Waymo, for instance, is one of those big bets that needs to continue to be invested in. We've all seen how companies like Apple, when they stop making big bets and they get away, it creates long-term risk. These companies create billions and billions of dollars of cash flow every quarter. They need to invest. We've heard Jensen Huang talk about physical AI. That's autonomy. That's bringing the real world in to connect to all this data center build out that we're doing. So I like the company, I like its long term, and I think it's underrated for its prospects in AI, and I think it's overestimated the risk of antitrust. Every Mag 7 company has some. I don't see the company being broken up, and I don't see an advantage to breaking the company up.
Let me ask you on that core question I was asking Laura about, which is this concern, Dan, that clearly some investors have about how AI disrupts search, how AI disrupts Google's bread and butter. What do you think Google needs to report, and what do you think executives have to say on that conference call to try to convince investors, hey, this isn't the worry maybe a lot of you think it is?
Well, it is a real concern, but every company right now, whether you're a SaaS company or you're Google, has to be rethinking about how they charge customers and how they make money. We know for certain that consumption and tokens are going to be the future of economics, and we know that if they hang on too long to the traditional pay-per-click, that there will be erosion. Having said that, I don't believe OpenAI has an advantage here. They're charging $200 a month. There's only so many people out there that are going to be willing to spend that much, not to mention they're completely surrounded by Microsoft Satya Nadella, who's not really letting them off the chains right now to move forward. Google is adding AI into many layers. They've got all that data advantage that Laura talked about. Totally agree with that. And they are already inserting and driving, and so many of the Luddites, our grandparents, our parents, they're not running off to use these new LLMs. They're still using Google, and now they're seeing AI. So Google needs to address how do they create revenue, tokens, how do they drive companies like Yahoo Finance to keep creating great content that can be crawled. We saw what happened with Cloudflare and them starting to block some of the crawling for these models. So there is going to be a push and pull on the business model. But I do believe Google can hang on long enough and eventually go to a new model that's more on a token output and it's an outcome output driven for its revenue.
I wonder if Google's advantage also, Dan, I just think about myself in terms of advantages versus an OpenAI. Yes, I'm using Google search, but I'm using Gmail. I'm using Maps, right? It's a sort of portfolio of experiences. How much of an advantage is that as well?
Well, that's why I sort of said there's no advantage to Google to have it broken up. There's so much ecosystem at play, the way they're able to pull it together. And by the way, they're putting their advanced LLM and generative tools right into Workspace. They're putting it right into the Meet tool, you know, the meetings tool that they have. YouTube data can feed how they're training these models. And then, of course, all of this data can feed the overall experiences that Google delivers. So I think the ecosystem matters. I think it's sticky. By the way, Microsoft's a little bit behind on its own AI development, but it's so sticky. Every enterprise on the planet uses it. Same reason Apple handsets, everyone uses it.
Oil locked in,
They have time to get it right.
Agreed. Dan, thank you. Coming up, we're tapping into the defense space as earnings season picks up steam. More market domination. That's on the other side. The defense sector starting to report earnings. Lockheed Martin and Northrop Grumman both announcing Q2 results on Tuesday. Those stocks moving in opposite directions. We're navigating how to play the defense sector this earnings season with the Yahoo Finance playbook. And joining me now is Richard Saffron, Senior Analyst of Aerospace and Defense at Seaport Research Partners. Richard, it is good to see you. So you got a few different defense names to talk about reporting and moving today, but let's start with a notable mover, Richard. That would be Lockheed Martin, which is under some real pressure. We're down more than 10% in today's trade. What do you make of their report results, Richard?
Yeah, I'm Well, it was quite obviously, as you noted from the stock reaction, very disappointing results. You had a miss all around versus expectations. The issue is that the street doesn't like surprises, and you had a bigger than expected charge on one of their classified programs at Aeronautics, and you had totally unexpected charges on some of their or losses on some of their helicopter programs. Nobody expected this. So quite obviously, Street doesn't like surprises, as I said, and the stock reaction, I think, reflects that. I think, what you'd have to consider here is you have a tale of two companies today. You mentioned Lockheed. We also had Northrop reporting today. I wouldn't be surprised if Northrop had a very good day, and I wouldn't be surprised if part of the stock reaction was people rotating out of Lockheed and into Northrop Grumman, for example.
And Rich, as they rotate out of Lockheed Martin here, I know you tell your clients this one's still a buy. Why is it a buy, Richard? What are the catalysts ahead?
So I think that the primary reason that this stock and defense in general remains a buy is, number one, I think today's reaction, just tactically, reaction was a bit of an overreaction. I mean, if you take a look at things and you subtract out the charges, et cetera, Lockheed actually would have beat expectations. But the primary reason I think defense and Lockheed remain a buy is you're looking at double-digit growth in addressable defense spending. So this would be investment spending in fiscal 26. And I think this is only the start of a long-term double-digit growth trend in defense spending. I think that this new administration is putting a high priority on modernization at the expense of some other discretionary spending items. I think Lockheed, Northrop, and other defense companies are going to benefit as a result.
Let's talk about some other names, too. I want to talk about one that's on deck in terms of General Dynamics. What do you expect to hear there, Richard?
I think they're going to have a pretty good day. I think primarily, if I take a look at government spending in a month, the biggest spending item was on Army spending. I think that could benefit their combat segment. But perhaps more importantly, I think that they're going to beat in their aerospace or business jet segment, these Gulfstream business jets that they make. General Dynamics is one of the premier manufacturers of high-end business jets. And I have them, for example, beating expectations by 10 cents tomorrow. I also think that they could take up their guide as a result of some better performance. Second quarter is typically when they do the update. So bottom line, I think we're going to have a good day with General Dynamics tomorrow.
So that all sounds very positive, Richard. But correct me if I'm wrong, my friend. You have a neutral on this name. So why the lukewarm rating?
Oh, well, General Dynamics did suffer quite a few execution issues and delays with its business jet. So, yeah, things are definitely on the mend there tomorrow. But the other thing, too, is I think, to a large degree, it was expected that things would eventually improve there. But my neutral rating was basically, it's been on for quite some period of time, but basically having to do with their business jet segment and the execution there.
Another name I want your take on while I have you, Boeing. I believe you're a believer on that one, Richard. You have a buy?
Absolutely. In fact, it's one of my highest conviction buys.
How come, Richard? Explain that one to us.
I think it's, one of the things you have to look at is we're at this, right now, I think Boeing is benefiting from vastly improved execution, and I think that's largely due to their new CEO, Kelly Ortberg, who I've known quite some period of time. So I think, number one, you're looking at a story where you've had some pretty bad execution and a number of issues on their 737 MAX and 787. I think that's clearly moving in the right direction. I expect to hear more good news on their conference call. But the primary reason I think to buy Boeing right now is that I think that we're at the start of an order cycle, that's an extended order cycle that's going to last quite some period of time. I think that's being driven by both pent-up demand, because we haven't had we have supply chain issues and executions at Boeing that I think have held back deliveries, and also because I think we're going to have replacement demand. I think, a lot of, as airplanes get older, they tend to be replaced. So I think all that's going to drive a rather long and extended aerospace cycle that I don't think is being priced in right now.
Richard, there's a broader theme in this industry I want your take on, because we've had defense analysts come on, Richard, and some of them have said, listen, the modern battlefield is changing. And their point is, Richard, yes, fighter jets in the future will still be important, and battleships and tanks, but increasingly, they argue, so will autonomous systems and robots, and AI will play an increasing role. Are the primes that you cover, Richard, are they well positioned to take advantage of this pivot?
Brilliant question, and I get asked this, quite a bit. And the answer is yes, but it depends on certain products. You have to remember, right? Large aerospace and defense firms like Lockheed and Northrop are very good and superb at very low volume, very high value added content manufacturing. And that's what makes them good at making fighter jets and certain autonomous systems. But as you get into, much smaller systems, handheld weapons and things like that, certain things where you're much more dependent on volume and less value added content, that's going to be suited to other manufacturers, et cetera. So I think absolutely, defense companies are very good. They're teaming with